is.
I think it's a great point. I mean, look, I think whenever you're dealing with a tech-enabled business, which I would define as a more traditional business model with some sort of software layer, on top of it, you have to kind of assess, like, how much of a difference does that software really make at the end of the day? In this case, this is a real estate business with a very thin kind of software slash
a veneer
slash
of technology.
The experience layer is a very small part of the overall, let's call it P&L of this business.
Such a great point. Sachs, I mean, a perfect analogy would be like if you're taking a flight on United, the United app is delightful now. It's a really good app. This is a commercial airline. It's called United Airlines, Sachs. You pay for one ticket instead of the whole plane. But
have you been to a McDonald's recently?
I actually went to McDonald's. Yeah, you order through an app now, and there's a big screen.
The point is, you walk in there, and it's probably not the McDonald's you knew 15 or 20 years ago. It's not about waiting in line and ordering, and that's not how it works anymore. So the point is that a tech-enabled business, or is that still a restaurant? Well, if you spend a lot of your time intellectually contorting yourself to try to justify why the next version of McDonald's is a tech-enabled business, you're just going to lose a lot of money. It's a restaurant. Yeah. Now, all restaurants need technology. And what you see by McDonald's is even the oldest and most established are running forward very quickly to implement technology because they know that it creates efficiency, which then flows to the bottom line for them.
Yeah.
So the reality is that we have lived in this wonderland where we've looked at these software businesses that have 80 and 90% gross margins and imposed that expectation on other markets, and then made investment decisions by trying to justify how that it's a tech-enabled real estate business, a tech-enabled healthcare business, a tech-enabled energy business, without being honest with ourselves that those businesses have over decades, because of lots of competition, found a consistent and reliable resting place in terms of gross margins far below 80 and 90%. And so instead of willing tech-enabled businesses to be at 80 and 90 and tricking oneself, I think it's more realistic to ask yourself, why aren't 80 and 90% gross margin businesses decaying to 30 and 40% gross margins like every other part of the economy when everything will be technology enabled? I think that that's a very reasonable question. And I think the answer is there is no safe place. I don't think that you can justify 80 and 90% gross margins in software when you can use a model and whip up a competitor. I just think that we are all going to a place where everything is a tech-enabled version of something.
Yeah, marketplaces would be a notable exception there with network effects. So DoorDash versus the tech-enabled restaurant, asset-light marketplaces. You and I, Sachs, have been involved in a bunch of different marketplaces together. Sometimes they're asset-heavy, sometimes they're asset-light. When they're asset-heavy, man, it's really hard to make those businesses work, huh, Sachs?
Yeah, I mean, I think we should differentiate between gross margin and then the net operating margin or profit, right? And so, gross margin is what is the cost on the margin of providing one incremental unit. And the thing about pure software businesses is that on the margin, you can provision another instance of the product almost for free. I mean, there's a little bit of hosting costs at AWS or whatever. So on the margins, it's like the perfect gross margin business.
As opposed to a hamburger.
As opposed to a restaurant is going to have very large costs of goods sold, or COGS. The simple heuristic that I use is just, does this company have large COGS, costs of goods sold, and are they physical world COGS? If they are, it's not a software business. It's at best a tech-enabled business. So just look for that. Does this business have large physical world COGS? Now, what I would say is if the COGS are virtual, like, it could be hosting costs or it could be paying Twilio for telephony or something like that, then at least it's still not like as good a business because the margins aren't as good, but it's very scalable, right? Because you don't have that like huge friction of needing to scale up physical world infrastructure, physical world supply chains, that kind of stuff. So I like virtual COGS a lot better, or digital COGS a lot better than physical COGS.
I love it when marketplaces, though. I mean, we could speak to that too. When I had Dara on the pod the other week, and when he launches an adjacency, hey, we're going to sell alcohol. Hey, we're going to sell groceries. Hey, we're going to add this thing that's right next to the already, portfolio of Uber offerings. Doesn't cost them much, right? They just have to get the supply side up and running, but they already have the demand side. And I think that's where like these super apps are doing really well, or Airbnb adding, some inventory in a new city that they unlock, right?
Well, true marketplaces are perfect gross margin businesses as well because they don't have physical inventory that they themselves own. What you'll see is with a lot of marketplaces, they'll cheat by buying the inventory themselves, at least to jumpstart the market and then selling it.
Yeah.
And so when you see that line item on the P&L, that they have real cost of goods sold, oh, wait a second, this isn't a true marketplace. They're providing the service.
Yeah.
And so again, it's just a way to like catch whether the business is truly one of these great high gross margin businesses or whether it's more of a tech-enabled business that's pretending to be a pure software business.
Yeah, direct to consumer got people in a lot of trouble during the last cycle in venture capital.
If you look at a lot of these companies, even the best SaaS businesses have seen their gross margins erode by about 15 to 20%. It used to be that best-in-class software business can generate 90, 91%, high 80s to low 90s gross margins. Now that's not true. You see a lot of these best-in-class companies that are in the high 60s to low 70s. So it already just shows you that pressure has come upon the market. And so is it that the software-enabled business goes towards 85, or is that the 85% gross margin business goes towards 30? It looks like it's the latter. That's just what the data says.
Well, maybe I'm just categorizing certain costs differently than you are, but I don't know why a software business would go all the way to 30, right? Because again, sales and marketing don't count in the gross margin. G&A doesn't count. Even R&D doesn't count in the gross margin. It has to be, a unit cost that you can attribute on the margin to that incremental instance of the product. So things like, again, paying Twilio for metered telephony or paying OpenAI for like metered API access, all of that is definitely in COGS. And I think some customer support costs that can be attributed on kind of a per instance basis, that goes in there. But if sales and marketing and R&D and G&A aren't going in there, I mean, I don't know why you go all the way to 30. I guess I'm just saying that I still think software businesses and marketplaces for that matter are still the best kinds of businesses on a margin profile basis. The problem is that there's a lot of fake software businesses or fake marketplaces out there that are pretending to be pure tech businesses when actually they're more like old school businesses that have the veneer of technology.
And I think to your point, they're like the trick of saying I'm an 80% gross margin business but having no profitability is then who cares? So
yeah,
when you look
true.
at the profit,
that is very true.
When you look at the profitability of these businesses, again, you'll be in the 20 to 30%. That's why when you see companies that are in the high 30s to low 50s, they're A, very unique, and B, you should expect that there is something fundamentally monopolistic about them. And that is the simplest way to filter out these companies, because in a highly competitive market, you cannot extract those kinds of profit dollars. Capitalism says you can't do that. So you can only do it when you have an N of 1 or N of 2 kind of competitive dynamic where there's essentially a mutual detente with your biggest competitor.
Yeah, it is a good point that just because you have good unit economics or good gross margins doesn't mean that the business is profitable at the end of the day.
Good. Yeah, it could be.
I mean,
totally
you can have
crap.
80% gross margins and still be losing a ton of money because you've got too much overhead, you've got too much sales and marketing, you've got too much
churn.
R&D. Yes.
So you're selling to customers who don't really need it, and then they eventually cancel, right? Like we see that a lot.
Look at the streamers. That's just a big recycling exercise. It's just like people come to the top of the funnel, they use the product, and then they leave, and then you have to reacquire them over and over again. And it could be the case that SaaS actually looks a little bit like that too at the bottom line level.
Well, when you hit your natural audience, it does get challenging. Yeah.
Well, this is why in SaaS, there's a heuristic called the rule of 40, which is for public market SaaS companies, you want to see that their operating margin plus their growth rate equals 40 or is greater than 40, ideally. So in other words, you could have a SaaS business with a 20% operating margin and a 20% growth rate, and that would hit rule of 40, and that would be a very attractive business. Or you could have, I don't know, it could be growing 50% year over year, and its operating margin could be negative 10%. And that'd be okay too, because they're losing money, but at least the investment is leading to well above average growth. or you could be growing, be growing slower. You could have a 10% growth rate and have a 30% operating margin, and that would also be hitting the rule of 40. So it's just a simple way of like tracking whether this is a good business at scale. I don't think startups have to worry about this until they get to kind of the later growth stage.
Yeah. When you're in your BC round, you're making 50, 100 million. Yeah, you got to be really thoughtful about this. In the beginning, you're trying to get product market fit and triangulate on something.